Good morning, traders. Richard getting a quick Ichimoku cloud chart market review of Bitcoin. Since yesterday's price action, we got to the next downside target, this top end of the old cloud chart shadow here. Significant support zone around about the 60,500 zone. Bitcoin hit 60,000 and then now fighting for support, fighting for a rebound at this zone. In the last update, we were just below the 73,000 zone as that support level broke, and then we had this target activated as this is the top end cloud chart support target. If support fails, if this rebound rally fails, then we could see a downward continuation towards the the bottom end of the cloud here, which is a 49,000 with 50,000 zone. Now, what I'm concerned about is this downward continuation pattern on the weekly. So if we just look at, let's say, that move down to there was about a 36% drop. Let me just fix it there. So then we had a bit of a relief rally, and then from that move there, that high there, to there was also a bit of a, another 39% drop. So we've kind of had a downward continuation pattern here. Down move, up consolidation, down move, and then we could technically see a third wave down. So if we get a rebound from here back up to this resistance zone, because that move there, that lasted for about a 21% rally, 20% retracement there. If we get that again from here, a 20% retracement would bring us roughly back up to that cloud chart support zone there, resistance zone now, because it used to be a support zone. And then from that point we could still see another 30 or 39, 36% drop, and that would roughly bring us a little bit below. Let's take it up to there, downward continuation pattern there is about 37, so roughly that zone there, just below about 46,000 there. And if we look at this zone, these lows here, so it could get us back down to the 49,000 pretty easily on a downward continuation basis. So watch out for that. A third wave down could hit the bottom end of the weekly Ichimoku cloud there. So that's an interesting scenario to look out for. If support manages to stay here at 60, let's say 60 is the new line in the sand for Bitcoin, then we could see a rally back up to this resistance zone, and once we get past 73, by that time the turning line of the Ichimoku cloud would have leveled out, and we expect that to level out in and around the bottom end of this old cloud chart, 79 or 80,000 basically. These are the upside resistance targets now that we get from the cloud chart shadow. We look at previous support zones, bottom end of the front of the Ichimoku cloud, as well as a rally all the way back up to the bottom end of the cloud here. So that's a scenario if this is the line in the sand, if the big buyers come back. All this is counter trend, of course, because from an Ichimoku cloud chart perspective, we're still trading back below the bottom end of the cloud. For Bitcoin to be bullish on the weekly, we need to be back on top of the Ichimoku cloud zone there. So we really need to be back above those levels to be bullish. So watch out for a third leg down to hit the 50,000, 49,000 bottom end support zone there. Keep a close eye for that as a potential major rebound zone if we get another downward continuation pattern within this kind of price action, in and around the support zones. On the daily Ichimoku cloud, key levels to watch out for now that we're fighting hard for support to rebound from the 60,000 zone. We're already at 66,000. First stop would be the turning line of Ichimoku cloud. After that, we'll got the upside target of the standard line of the Ichimoku cloud, and then another rally towards the bottom end of the Ichimoku cloud. So these are kind of technical relief rallies and an overall downtrend on Bitcoin. So price action below the cloud is bearish. But from a big picture perspective, watch very closely to see if the support's going to hold here, and then the upside target would be the next zone, the resistance zone from Ichimoku cloud chart perspective at 73,595. Thank you for watching. Until next time, happy cloud chart trading. Bye for now.